Hello, I'm Kenneth Himmler, Sr., and I'm the CEO and founder of Integrated Asset Management, a wealth management and financial planning firm. And today we're going to be talking about what constitutes a long-term capital gain that you must report on Schedule D. First off, let me define what the IRS considers long-term and short-term gain. Long-term gain is any investment, business, or item held for profit or the intention of profit greater than 1 year. If it's held less than 1 year, it's often referred to as an ordinary income item. Even though it is held for profit, it's considered an ordinary income item. Therefore, if you have an investment that you are holding greater than 1 year, 1 day, it may qualify for the long-term capital gains tax treatment. Now, under the new rules with the IRS, these will dictate what rate you pay, which is mandated on your actual income. So currently, if you earn greater than a certain limit, single or joint, you may pay either the lower, or if you exceed those limits, the higher capital gains tax rates. Now, here's a suggestion. If you are taking capital losses, those could be short-term or long-term. Those are generally netted out on your Schedule D, and they are put on your 1040 tax return. Now, many people are very misinformed. They have many losses, but they don't want to realize those losses because they think that they are only entitled to $3,000 in a deduction. Let me clarify. Let's say that you bought a stock for $50,000 and it is now worth $25,000. You don't want to sell it because you don't think that you'll be entitled to the $25,000 deduction. Here's my suggestion. If the stock does not have, or whatever the investment is, that much potential to grow, you don't want to lose money against inflation. Sell the investment. You will now be entitled to the full $25,000 tax write-off. But that's going to be limited by your capital gains. Now, if in that particular year you have a $25,000 capital gain, you can wash off the tax by using your $25,000 capital loss. On the flip side, let's assume you have no gain whatsoever. You can take a $3,000 deduction, but here's the gift. You can take it against ordinary income, which in most cases is going to have a much higher tax bracket than capital gains. Now, the benefit is if you had a $25,000 loss, you may take the $3,000 year one, and then next year you can do it again. And you can continue to take that loss until you use up the entire $25,000 loss. And again, that's not a bad thing. If I gave you the option of a deduction, would you rather take the deduction against a gain or against ordinary income? Always against ordinary income because it's going to be at a higher bracket. So hopefully that helps you realize that if you have losses, don't overlook them. Sometimes it will help you to realize those and take the deductions. Again, I'm Kenneth Himmler, Sr. Have a great day.